Nick Tuffley, thanks for joining us today to talk about what's happening with interest rates and messages for mortgage advisors. In this very low interest rate environment we have at the moment, what is the sort of advice that mortgage advisors should be giving their clients?
Well, for one, we're likely to see short-term interest rates come down a little bit further. The cash rate's likely to fall to at least 2%, if not possibly down to 1.75%. And we think that the cash rate's going to remain on hold for a good couple of years. So you've got an environment where floating rates and short-term fixed rates are likely to remain low and stable for some time. And even the longer-term rates, whilst they're likely to get dragged up by overseas events, they're also still going to remain relatively low. So quite a lot of stability in our short-term rates and low interest rates here for a long time.
And in terms of a sort of a strategy, would you think that using the shorter term rates like 1 and 2 years is the way to go at the moment?
When we do our calculations and estimate where rates are going to be over time, what we tend to find is that the cheaper options do tend to be those shorter term fixed rates of 1, possibly 2 years. Fixing for longer than that, you obviously get a lot more certainty about what rate you're going to pay, but the premium that you're paying for that doesn't seem to be worth it if interest rates are going to remain low for a couple of years.
I understand there's a lot of people trying to break longer term rates at the moment to get onto some of the lower rates. Are you guys seeing that?
I think there's always a degree of that comes through, and certainly what you do have is a lot of people anticipating this low interest rate environment. So it's just been incredible when you step back and look over the last number of years just how low rates have managed to get compared to where we saw them before the financial crisis.
What sort of shocks would have to come onto the economy to suddenly see interest rates start to lift again quickly?
I think for that to happen, you either need to have one good shock and possibly one bad shock on the other side. So look, a good shock will be if our growth started to get very, very strong and inflation pressures come back quite sharply because of that strong growth. That's when you're likely to see the Reserve Bank putting the cash rate up to just call the economy back to a sustainable pace. So that will be one scenario for higher interest rates. The other one, perhaps the not so good one, and we saw elements of that during the financial crisis, and that is if there was some sort of global stress that meant that risk premium globally lifted quite sharply, that could affect the New Zealand banking sector's cost of funds when raising money offshore. So that might be one possible impact.
Yeah. And with the cash rate getting down to 1.75% as ASB is predicting, where do you think that floating and short-term rates will get to? Will we go sub 4?
Oh, well, you're likely to see, I'd say, that a reasonable majority of the cash rate cuts flow through into the floating rates. With the fixed rates, we've got to be a bit more careful because the wholesale rates are already building in a fairly decent fall in the cash rate. So the scope for them to fall is a bit limited from where we are now.
And just finally, on sort of macro-prudential tools from the Reserve Bank to try and slow the housing market down, do you have any sort of predictions of what might happen there and whether these tools actually work?
Well, we do think there's a greater risk that the Reserve Bank beefs up the tools that it's using. So if it was to do something this year, it's most likely to just expand the current loan-to-value ratio restrictions. So it could look at making that Auckland investor deposit threshold go up from 30% to say 35 or 40%. But what we do know is that when you put that restriction into place, it tends to push activity elsewhere, and the Reserve Bank gets worried about what's happening elsewhere. It could well expand that investor threshold elsewhere around the country. But the quick easy one is the loan to value ratio restrictions. Other alternative tools still really aren't well developed at this stage. And the effects of them, don't seem to be permanent. Look, the last two sets of restrictions we've seen come in place, the effects have largely tapered off after about 6 months.
And I know when they did the last OCR announcement, they said they weren't thinking of any more tools, but you just never know what they'll do you?
Well, we do know that there's around the world focus on things like, say, debt to income type servicing ideas. That's something the Reserve Bank has been looking into, but we'd say that they still have quite a bit of work to do to get that on the go. For one thing, even just defining what income is consistently throughout the industry would need to be done first. So we're still a long way from a measure like that coming into place.
Excellent. Thank you very much for your time, Nick.
You're welcome.